Hey everyone, hope you're having a good day. My name's Andy, the channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in. Take a look, see what is going on today. If you want to follow me, it's at Finance. If you want to join our community, finding-value.com. We do midweek updates, individual companies. We do on the weekend Q&A sessions, either Saturday or Sunday, where I answer your guys' questions and post that onto the website. The value is through the Q&A sessions where I go over a variety of different things, conference calls, not conference calls, but earnings calls for companies. I answer your guys' questions. Sometimes I do training sessions in the beginning of them and go over kind of what I'm seeing in the markets and how I am determining the entry points and why some of these sectors I'm looking at from a historical basis. Special coupon code that we have active, you type in special and you get a discount if you'd like to join. So coming on down, we've got commodities. This is Cole Smead. He says commodities are going to outperform the S&P 500 in this cycle. Says Cole Smead. I approve this message. The first thing that came into my mind was J. Cole, and it was like a shirt, but I think it was J. Crew that I am thinking of. So when I read Cole, is this one of the biggest squeezes in the markets, perhaps, before it unleashes? This is U.S. oil divided by the S&P 500, and I'm getting a little bit Cole Smead on this. You know what I mean? Cole's saying that commodities are going to outperform the S&P 500. So you know what? I got to throw some oil to S&P ratios up here. We are squeezing into this corner here, guys. Something's about to get unleashed. I'm talking unleashed. What I think is going to occur is we're going to break out of this squeeze in the corner here, and oil is going to explode. Explode. I think it's going to beat gold. I think it could beat everything. Oil's looking real interesting here, and this is exactly what I look for. This is going back to 1893 back here. You get the big hump, the second one, the third one, and we are squeezing right into the corner. If you zoom in on the right-hand corner there, this is what we've got. We've got another dream within the dream, a falling wedge, which is the big boy, with a three-hump consolidation. This big one, well, maybe you could get this, consider that one too, but it's squeezing in. And then we've got another squeeze here, squeezing on up. And we've broken through the top trend, and we're doing a retest, and hopefully we can get moving and break out of all of this. Obviously, oil's not going to be the only thing that outperforms here. We could see the S&P 500 underperform for a period of time, or even go lower to push this ratio upward dramatically. So I think this looks really good with U.S. oil versus SPX. Here's another one. This is U.S. oil divided by the NASDAQ Composite Index. Usually you get a squeeze in the front, then you get a double bottom, which we're at the bottom of the double bottom, but then you get another double bottom. So we have another dream within a dream. Your dream here of the bigger, longer picture view, squeeze, bottom. Then you have this guy here, the falling wedge. If I zoomed in, I cut off a little bit of that falling wedge. And then you have another double bottom. And then you have another falling wedge in the right-hand side that we've broken out there. That is what I consider to be the dream within a dream within a dream. It's Inception. You know the movie Inception where these guys are doing multiple dreams? There it is. This is Inception here, where you get the, you get an alignment of US oil versus SPX. Then you've got the squeeze. But you also on the ratio have the double bottom, and then the double bottom is probably forming over here too, in this corner here. So I think that this could be the bottom of the bottom of the bottom on different time frames of long term, medium term, and short term. I call that the dream within the dream within the dream. And we could be playing out here. Now, that doesn't mean that we automatically just rip higher, because it should be close. So we could still chop a little bit around sideways here, but we're getting real close. for this to all kind of unwind the valuation difference of oil versus the financial assets that I just showed there. This is platinum ratios against other metals energy. And obviously, a lot of people are looking at platinum. Platinum made a very big breakout. So I was like, you know what? Let's just do a bunch of ratios on it. See what the heck is going on here. So this is crude oil versus platinum. And platinum's been crushing crude oil here in the short term. It's done, platinum's crushing a lot of stuff. So it's doing that. It's coming back towards the mean, maybe towards the bottom there. Platinum's made a pretty mean reversal against uranium. So we've got this falling wedge into the corner there. In fact, let's draw it. Platinum divided by uranium. And usually what occurs is you get kind of a falling wedge in the corner there. And then you start to break higher out of it. So your bottom here was in 2024. Precisely the area, this whole area, platinum really wasn't moving down. Uranium was moving up here too. But this whole area for platinum was a big buy when it was chopping sideways. And I'll show you the platinum chart in a bit. Platinum versus lithium. Lithium's had a pretty big move lower, but now platinum's kicking it when it's down. it's kicking it when it's down. And then this is platinum versus copper. I thought this was a really interesting chart. You got the one hump, the two hump, and then the third hump, and we are breaking that falling wedge to the upside. I'm also showing some other ratio charts here. The next one says platinum looking very strong. More falling wedges, which is very bullish for platinum. I mean, platinum is setting up against all of these other commodities, and I think it's just going to dunk on everything. Really, I honestly think the possibility that platinum could dunk on it for like a year or two coming up here. So platinum versus silver. Silver, they say, is the cheapest commodity out there. It's so cheap, it's so amazing. But here's platinum, even cheaper than silver. So platinum is technically one of the cheapest commodities. Oil is real cheap, and so is natural gas. But platinum, putting in the corner here, the 3M consolidation, and it is almost breaking out here. It's right at the resistance spot to break out against silver. But this is platinum priced in dollars. You can see the big breakout on the right-hand side. It's like a big middle finger to everyone who is doubting platinum. I would agree with that statement. Here's platinum versus gold, and guess what? That's also breaking out of its downtrend here to the upside. Looks fantastic to outperform everything. So that's starting to break out. And this is platinum versus palladium. That already is moving higher. The substitution where platinum is substituting palladium. And that's the cycle. We're at the bottom of the cycle here in 2020, 21, 22, 23. Another thing to think about, platinum is the cheapest against all of the metals during that time frame. I've showed you gold, palladium, and silver. And platinum is cheap against all of them. During that time, that has historically been the best time to purchase a metal, is when the metal is the cheapest against all the other metals. That occurred with silver in 2000, palladium in 2009, rhodium in 2016. Gold was 99 2000. It was way down there. And gold and silver were both cheap in 99 2000. That's when things were bottoming. So that's just some background on ratios there. Warren Buffett, the 5-factor framework for assessing the risk of an investment. All right, let's see what he uses for this 5-factor framework for assessing risk. So I'm going to read this whole thing here. He says, in our opinion, the real risk that an investor must assess is whether his aggregate after-tax receipts from an investment, including those he receives on sale, will, over his prospective holding period, give him at least as much purchasing power as he had to begin with, plus a modest rate of interest on that initial stake. Totally agree with that. Though this risk cannot be calculated with engineering precision, it can in some cases be judged with a degree of accuracy that is useful. The primary factors bearing upon the evaluation are these next 5. The certainty with which the long-term economic characteristics of the business can be evaluated. Number 2, the certainty with which management can be evaluated, both as its ability to realize the full potential of business and to wisely employ its cash flows. Number three, the certainty with which management can be counted on to channel the rewards from the business to the shareholders rather than itself. So rather than paying themselves large salaries or paying themselves insane stock option bonuses, whatever it is, to give it back to the shareholders. Number four, the purchase price of the business, how expensive or cheap it is. Number five, the levels of taxation and inflation that will be experienced and that will determine the degree by which an investor's purchasing power return is reduced from his gross return. Just as Justice Stewart found it impossible to formulate a test for obscenity, but nevertheless asserted, I know it when I see it, so also can investors, in an inexact but useful way, see the risks inherent in certain investments without reference to complex equations or price histories. So it's kind of a thumb up method, thumb up approach method. You lick your thumb, put it up, you can tell where the wind is blowing. You can tell where the risk is at. If you look at enough companies, you don't have to dive into the numbers. You can tell if management is skimming off the top too much. You can tell their Cadillac plans for insurance. You can tell that there's next gen logos sitting on front of Formula One cars. You can tell that money is not being, you know, held within the business and potentially returned to stockholders. You can kind of tell with time after you look at some of these things. Funny to read that crude oil price projections at 120 from exactly those who a few weeks ago forecasted $40 or $50 for 2025. Guys, I just think that most people are really bad forecasters, and I think they're bad because I just don't think prices can be forecasted. I mean, that's what it ultimately comes down to. So use something other than price forecasting. Price forecasting is garbage. It doesn't get you anything. Why don't you just look at valuations and buy when things are cheap and then just sit in it when it's cheap and then wait for it to go up? I mean, that's all you can do. The price forecast guys, they're all getting it wrong, or girls, whoever's trying to do price forecasts. Thinking Trump said that something could happen in the Middle East and it could be a very big conflict. Oh, well, I guess that's all upside for oil and gold. Maybe that's what's going on. Maybe things are about to pop off in the Middle East. I don't know. It doesn't really matter to me, to be honest. It really doesn't. Not that there's a conflict, but I'm not investing in oil because of a conflict. I'm investing in oil because the pattern's big and it's cheap. It's cheap as crap. So those two things definitely catches my interest. So could something happen? This is what my opinion is. The pattern suggests that something occurs. And I think they need an excuse for why oil is about to go vertical. That's what I think. They need an excuse. So it's not something could happen in the Middle East. They need an excuse for something to occur so they can blame the oil price going up to $300, $400 a barrel. HFI Research says, hilarious. On top of this, you have Chris Wright saying U.S. crude oil production won't drop. So Javier Blas says U.S. President Donald Trump speaking at the White House today and referring directly to the U.S. Secretary of Energy Chris Wright in the audience. Says, Chris, you're doing great, but I don't like that oil price has gone up just a little bit over the last few days. I was going to call and really start screaming at you. Are we okay? Nothing wrong, right? Is going to keep going down, right? Because we have inflation under control. What is he talking about here? Is he talking literally, AKA, let's try to control the oil price to go down? Because we have the inflation under control. Is he kind of like Freudian slipping this, saying What's going on with oil prices? Why are they going up? I thought we had that under control because we have inflation under control, aka. You know what I'm saying? Drill, baby, drill. That's why it's going down. Yeah. Phew. Bulls are still safe. Sankey reaffirms his $40 oil call. Cheers. So he's still calling for $40 oil. He says $40 oil is still good. Here's why. And he has a YouTube video there if you want to see his opinions on why he thinks that oil is still going to $40. I don't know. The chart to me looks pretty bullish for oil to go up. Here's Steven. He says failed tops, intermarket analysis, and the scoop and score on crude oil. He says crude oil is going higher. Steven Straza, I approve this message. Sure looks good for that to occur. Looks good to go higher. Now, Trump talking to Chris Wright, how are they going to pull that off? This whole chart's all messed up on. They tried breaking lower with the Liberation Day, but all that created was a big bottoming pattern. It was a flushed out false breakdown, going into a slingshot squeeze higher, potentially. Freight futures AM update. We've got dry bulk, Capesize, and Panamax up 1% each. Tankers are up. VLCC's up 1%, and Suezmax is flat. Rock bottom entries. The U.S. dollar is testing its 14-year uptrend line. We're on the cusp of a commodity supercycle, reminiscent of 2002 and 2008 when the dollar dropped. And there's the commodity supercycle with the dollar dropping. We dropped through this uptrend line. We very well could see strength in commodities and precious metals, and that's exactly what we're seeing. We're seeing people front running it. That's why we're seeing oil here putting in a shoulder, head, shoulder, ready to go higher. This isn't oil going up. It's the dollar going down. A nice little shoulder, head, shoulder potentially we've got going on there. A game-ending move on that trend there for the dollar, the DXY. Katusa. Oil's been playing ping pong between $60 and $72 for a year. That April crash below $60 could have been the bear trap of the century. Now racing back to $72 resistance like it owes rent. When it breaks through, buckle up. The next stop is $80+ dollars. The most boring chart just became the most explosive trade. There's that shoulder, head, shoulder bottoming pattern that we're ready to go higher. Trump is talking to Chris Wright. Hey, is everything okay, buddy? Do we need to get the plunge protection team on this? Do we need to start trying to get interest rates down and crude oil price down? I don't know, guys. This looks pretty bullish to me, and I think Katusa's seeing it too. The key is to save as much as you can as early as you can. That's called compounding. If you understand compounding, you want to save as much as you can as early as you can, and then compound the crap out of it. Oh my, Japan 2.0, says Great Marty, and this is, they did it again. The U.S. Treasury just bought back another $10 billion of its own debt, matching the largest Treasury buyback in history. Got to keep buying those bonds. And that's all I've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special coupon code, and we'll catch you next time. This is Finding Value.